Hey there, in this video, you're going to learn why not to invest in Class A multifamily syndications. Hey, everyone's got an opinion, you're entitled to yours, but some people are wrong. Here's why you should not. Now, we're going to get into this topic, and to help us with this is our Investor Relations Director, Bronson Hill. Bronson, how's it going today?
Hey, Michael. It's so good to be with you and be with our investors today and those trying to educate themselves. The question that comes up, sometimes that people hear about a lot of funds and a lot of things that go on where they're looking at Class A multifamily. Maybe you could just talk for a minute to everyone about Class A multifamily. What are the benefits and risks as an investor?
Yeah, so Class A is all the new shiny stuff that's being built. The cranes, that's all Class A. It's luxury. It's the most expensive rental property you can. It's sexy. It's in great cities like Miami and wherever, and that's Class A. And a lot of people are attracted to that, and we tend to stay away from that.
Yeah, and maybe so can you explain a little bit more, like what is the what is the reason for that? Like why is Class A bad, or what are maybe the other options?
Well, it's not bad. It's not bad, but we don't like it. And the main reason really is risk and return, right? The risk return. Let's look at the risk side as well. We don't really like the way that Class A performed in the last recession. What happens in the recession was Class A luxury, and Miami is a classic example of that. I mean, I remember even before the recession, you see all these cranes up in Miami, and then of course when the crash happened, over half of the units were empty. Why? Because the people couldn't afford the rent anymore. People were losing their houses. So what happens is they in a recession, people need to downsize, and so they tend to people from houses will then move into rental property, but not luxury, because luxury is about the same as a house in many cases. So they're going to go into more maybe a Class B stuff. Class B is stuff that is built in the 80s and 90s, maybe the early 2000s, and Class A is built in the last 10 years. So they will exit the residential houses in the Class A and go into more Class B type stuff. And so we don't love that. Even in Houston a few years ago, when the oil spiked, Houston's Class A market really got hit for a period of about 12 months. A lot of concessions, a lot of vacancies, and we don't love that. We don't love that. Now, in great times, it's fantastic, right? Now, the returns are lower, obviously, because they're so expensive to build, number one, and everybody wants to be in them. It's just sexy to have, Class A property in London or Paris. But again, we don't like the way that it behaved in the recession. The stuff that we invest in Class B minus, C plus is much more recession proof. Because, like I said, in bad times, people will tend to migrate into the Class B, C property, and in good times, people will upgrade from, say, Class C into Class B. So really, they're converging in both markets in Class B, which is where we like to play, and that's why I like Class B as much. So those are my thoughts on Class A, some of the pros and cons. The pros, of course, is that you don't have any major repair issues. You're not going to have a major sewer pipe or a problem with electrical that you have in some of the older properties, right? The downside, of course, is the recession, the nature of the recession, and also the returns are going to be lower as well. So there's some pros and cons there. A lot of the larger funds, Bronson, really gravitate towards Class A. But here's the reason for that. They have a much longer time horizon. So if you look at some of these insurance funds or these REITs, they're not looking to make a return in the next 3 to 5 years. We do. We want to have returns for our investors, and we want to move that money. And the best way to do that is by creating value add deals, getting into deals, creating value, refinancing out, returning the capital, and doing it again. But these REITs and these insurance companies, trusts, they have a 20-year time horizon, right? So if there's a recession that happens, they're not really too concerned. They know that in these large cities like Paris and New York and San Francisco, in the long run, real estate will almost always appreciate, and that's kind of what they want. They want more of that long-term security, and they don't really need a large return. They don't need a large cash on cash. And so that's why you see a lot of these larger funds gravitate towards Class A.
Thanks, Michael. That's really great. I think Warren Buffett said it this way: is you always try to have a margin of safety in your investment. So being very conservative, you can come in and try to find this margin of safety. And we feel that the value add approach really gives us that, because we feel like we come in, we can add that value, we increase the rents. And even if there was some sort of recession, you have this, incredible value you've added, and it puts some buffer there. Were you going to add something?
Yeah, that's a good point. That's another benefit of the value add. Let's say we get into a deal, like we get into a Class B minus deal, and then we get in a Class A deal, same time. Okay, now let's say in 18 months there's a market correction. Okay, so in a Class A, I got nowhere to go. It wasn't a value add deal, so the only way to go is essentially down. Okay, rents are going to go down, vacancy is going to go up. But my value add deal, I've had 12 to 18 months to build value, which means that I've been able to increase my rents and my occupancy, whatever problem I'm solving. So when a recession, I'm already ahead of the game now. I have that margin that you talked about, that Warren Buffett talks about, that margin of safety. I built this buffer up. Now, in a market correction, am I going to be affected by that? Yeah, sure. My vacancy is going to go up a little bit, and my rent may stay the same or go slightly down, but I'm already way up, right? So now I'm way up, and now I'm pushed down a little bit, but I'm still far above my safety net of when I purchased a property. So that's another great reason to do a value add versus not doing a value add.
Absolutely. I think that's something that every investor should consider, is looking at more value add deals, those B and C class deals. So thanks again, Michael, for coming and sharing today. Wanted to just speak to our audience for a minute. If maybe you're new to this and this is something you're kind of just hearing about, and you're wondering, should I invest in multifamily syndications or the stock market, kind of like you've been doing? We have a report that Michael's put together where it compares the long-term returns of the stock market to syndicated multifamily. So that's at themichaelblanc.com/report. And it's a great report. We'll just kind of show the long-term benefits in the returns and lower volatility and all that stuff of multifamily syndication. Secondly, if you feel like you are on board, I want to take the next step. I would love to find out what sort of deals you guys are doing at Nighthawk Equity, which is our passive investing company. Then go take a look at nighthawkequity.com and click the join button. We'll get you on our investment list. We'll be able to start a relationship where we can let you know about upcoming deals. Thanks for taking the time to educate yourself, and we will see you on the next video.
Hey, and before you go, make sure you subscribe to my YouTube channel, because we're putting stuff out every single week. Also, check out this special report just for you. It's what's the best investment, the stock market or real estate? It's going to blow your mind. And here's another video for you to check out.